Hello everyone, and thanks for joining in. Sorry for a small delay. We've got some technical issues, but I believe now we should good to go. Let me do a quick check on a quality stream. Let me know if we have sound issues or video issues. So far, stream is available in 720 quality and everything should look okay. Let's move on. So let's go to the schedule. All information we need is in the schedule. And today's lecture is about income statement. We did a bit of a income statement review on the previous module, and today we conclude with income statement with MIT lectures on income statement, and we will start discussing accrual basis of accounting. Let's see. Let's see. I will post a quick reminder. I will post a quick reminder to the groups. It's probably too early on Saturday, and it's Halloween Saturday, so we do not have much of attendance. But anyway, so today is an income statement day and accrual basis day. Let's see what MIT lecturers have to say about that. So they are discussing, and that's one of the results which we covered previously. So Qmart buys 10,000 worth of cereals from Special Foods. So basically we spent cash, we got inventory. And that inventory, it sits in our warehouse. And we have not recorded any expense yet. We have not recorded any cost of sales yet. We just recorded cash outflow and we recorded inventory inflow. What else do we have here? So we sold half for 8,000. We got 8,000 cash. We credit 8,000 to revenue, which then goes into retained earnings. We figure out the cost, 5,000. Then we calculated that increase in retained earnings is 3,000. Here we got 10,000 worth of inventory for 10,000 cash. Then we sold half for 8,000. So we reflected 5,000 as cost of sales. If you have any questions with that, you can ask these questions in the Q&A sessions. Or right now, I will try to answer questions today as well. So what else do we have? We even have a gross margin calculated here. So we kind of earned $3,000 on 8,000 of revenue. Components of income. So first of all, we figure out what the revenue is. Then we deduct cost of goods sold from the revenue. We deduct operating expenses. We deduct unusual or infrequent items. And we deduct income tax expense. And we got income from continuing operations. There might be a situation in a complex business when you discontinue operations of part of your business. Transactions like that need a separate special treatment, and they will be the results from these discontinued operations will be a separate line on your income statement, not included in your usual transactions. So, okay. Again, let me know if you have quality or sound issues. It seems I have some problems with YouTube Studio, and I do not see if anyone is watching. But let's continue. Here they provide an example of the income statement. For some reason the format is weird. You have like all these zeros here. So basically that amount is probably just $8,000. That amount is 1.7 million. So we just ignore the zeros here. Let's see, we have 11 million sales, cost of goods sold. I don't know what is occupancy costs. Okay, anyway, cost of goods sold, 8 million. Gross profit, 3 million. And then we have operating expenses. Operating and selling expenses, pre-opening, general and administrative, amortization of intangibles. Depreciation of fixed assets, it usually sits in the cost of goods sold. However, sometimes companies love to separate that in order to make accountants' life easier when we want to calculate some adjusted earnings like EBITDA, non-GAAP measures. Okay, we have interest here, so that's the total for expenses, and we have a net income here. That's pretty old format. Let's move back. Whom do we have here? Apple. Let's look at Apple 2 financial statements. So here is the income statement of Apple. We've already taken a look at it for a couple of times. We've got products, we've got services, we've got total sales from products and services, we got cost of sales for both. We have research and development separately here. We have sales and administrative here. We got calculation of operating income and other income expense net. So income before income tax, net income, and earnings per share. Basically, every income statement as well as a balance sheet will have more or less the same structure. Let's see what else do we have here. There is a cash flow presentation statement. It's a bit confused with these zeros. So the essence of cash flow statements, and mainly indirect cash flow statements, is that you start with net income. Then you make an adjustments to figure out your operating cash flow. It's just purely your operations, like a real business. Then you also have investing activities, when you invest money or in something, in some long-term assets, and when you dispose of some long-term assets. So like if you acquire property, plant and equipment, that's investment, that's not standard operating activity. Or if you acquire the business, so we got an outflow here. And we also got financing activities. Financing activities is your activities with lenders when you borrow cash or repay cash, as well as your activities with owners of the business, like when you pay dividends, but dividends might go into operating activities as well. And interest usually sits in the operating activities. So that's about cash flow. That's cash flow statement. By some a bit strange logic, they come up with cash flow accounting versus accrual accounting. In official income statements in public companies, that's how you measure cash flow and accrual accounting. So your cash flow statement will measure your cash flow activities, and your income statement will measure accrual accounting. So here we say we compare cash inflows with the cash outflows for cash flow accounting, while in accrual we compare revenues which are done when earning process is complete, with expenses, which are recognized when assets are consumed or liabilities are created. And that is geared toward performance measurement that is not skewed by investment, financing, and long-term horizon operational activities. That's very interesting, because if you use a cash basis of accounting, you can manipulate your cash easily by paying expenses early or paying expenses late, getting loans from banks or repaying loans to the banks. So now let's take a break from MAT for a bit, and let's go to homework, to my file in the homework. Let's see. Homework public, copy me. Here it is. And let's go to transaction tab. I updated that file a bit compared to the previous periods. Sorry, give me a second. Okay, so I updated that file to include cash basis accounting, accrual basis accounting, which is US GAAP. So accrual basis of accounting, it's US GAAP. It's kind of official classic accounting. Small businesses, in some circumstances, small businesses might want to use cash basis of accounting or hybrid basis of accounting, when they mixed some concept from accrual basis and some concept from the cash basis. Why can it matter? It can matter on the complexity of your future tax process. Tax IRS will also allow you to use what they call the cash basis for taxation. And they also allow you to use accrual basis of taxation. But IRS view on the transactions is totally different from accounting view on the transactions. Let's go through a couple of examples here. For example, cash, our first transaction, we invested funds into a business. Debit cash, credit equity. Because cash is involved, that transaction will look the same in every basis of accounting. So it will be the same transaction under accrual basis, cash basis, and tax basis of accounting. It's just transaction when actual event happened at the same time with the cash movement. Let's see what happens if we acquire building under a mortgage. For accrual accounting, we recognize the building, we recognize the cash outflow, and we recognize the mortgage. For the cash basis accounting, under a cash basis accounting, if it's pure cash basis accounting, if it's not hybrid something, if it's not mixed, we just recognize cash flow. So we have 50,000 outflow of the cash, and we do not recognize like assets. So we have 50,000 cash outflow, and I call that kind of a support account, expenses, cash basis. So I recognize these 50,000 as expense on a cash basis. As you can see, tax basis for that transaction, it matches accrual basis for that transaction. And that transaction, it basically doesn't make much sense. But if you're a small business owner, and if you buy only minor stuff like $1,000, then in that circumstances, you might be good enough to use cash basis of accounting. Okay, merchandise is acquired for 20,000 cash. That's one of the fields where it starts to make probably sense. So under accrual basis, we recognize an asset, inventory, and we recognize a credit cash outflow. Under cash basis of accounting, that will be like a cash expense. And so that's a cash outflow, that's why that's a cash expense. However, in taxation, that is still an capitalized. That is still capitalized. How do we know? How do we know that? We will have a next lesson about where we look into more details for that. But if we go, so if someone will skip that, let's see where my schedule is. Okay, here we have IRS publications. I am sharing you with the link here. And in IRS publications, we have two publications, 535 and 538, if I remember that correctly. So 538 and 535. 535 is called business expenses, and that's basically the main, like your main document as a small business. And 538 is accounting periods and methods. Let's see if I can find it in PDF here. Oh, sorry. They have links to PDFs here. Okay, 535, 538. So what we looked at the inventory. Let's find that out. Inventory. So that publication doesn't discuss inventories separately, which is a bit strange, but maybe we will find it out later. Let's see here. Wow, it's just 100 of matches. Let's see. Exception for inventory goods. Okay. Substantial advance payment. Inventories. An inventory is necessary to clearly show income when the production, purchase, or sale of merchandise is an income producing factor. To figure out your taxable income, you must value your inventory at the beginning and end of each year. To determine the value, you need a method for identifying the items in your inventory. Exception for small business taxpayer. You can choose not to keep an inventory, but you must still use a method of accounting for inventory that clearly reflects income. If you choose not to keep inventory, you will not be treated as failing to clearly reflect income if your method of accounting for inventory treats inventory as non-incidental material or supplies or conforms to your financial accounting treatment for inventories. If, however, you choose to keep inventory, you generally must use an accrual method of accounting. So basically, what is happening here is that in most circumstances, IRS wants you to keep inventory and doesn't allow you to expense your inventory when you bought it. But they give you a small exception here. They are giving you a small exception here that treating inventory as non-incidental materials and supplies. If you account for inventories as materials and supplies that are not incidental, you deduct the amounts paid to acquire or produce the inventoriable items treated as materials and supplies in the year in which they are first used or consumed in your operations. So basically, not for finished goods, but for materials and supplies, that say that if you used or consumed the material in your operations, you can deduct it as an expense. But it seems like if you still have it on your balance sheet, you kind of have to present it as an inventory. Let's move back to our transactions. Okay. So even though you still have that as an expense as the cash basis accrue, because that is a finished goods, under the tax treatment, even if you use a cash basis, you will still recognize it as an, you will still capitalize it and not recognize it as an expense under the tax basis. Okay, reclassification of the mortgage. So no cash moved, so no entry here. Everything else will match. Equipment purchase. For equipment purchase, in accrual basis of accounting, we capitalize the equipment purchased. Under the cash basis, we expense the equipment purchase. For the taxation, we generally capitalize the equipment purchased. And let's see what our guidance has to say about that. Let's go here, publication 535. Deducting business expenses, costs you can deduct or capitalize. So there is a bunch of codes. There is a separate paragraph about costs which we can deduct or capitalize. But let's see. Capitalize. Oh, we have a lot of matches here. Capital expenses. So here it is. You must capitalize rather than deduct some costs. These costs are a part of your investments in your business and are called capital expenses. Capital expenses are considered assets in your business. In general, you capitalize three types of costs: business startup costs, business assets, improvements. And there is also a uniform capitalization rule, which talks about inventories. We will work further on that in some time, but let's find out the treatment. So basically from that paragraph, we can conclude that when we buy an asset, business assets, we must capitalize that. Let's see. Do we have any match? Business assets. Yeah, we have a separate paragraph on business assets, and we will use it right now. There are many different kinds of business assets: land, buildings, machinery, furniture, stock, blah blah blah. Certain property produced for use in your trade or business must be capitalized under the uniform capitalization rules. That uniform capitalization rules mostly deals with inventories. Let's see. we have a de minimis safe harbor for tangible property, which says that although you must generally capitalize costs to acquire or produce real or tangible personal property used in your trade or business. I know I am kind of bombarding you with the definitions here, like what is real property? Real property is like land and something that is attached to that land, like a non-movable property. And tangible personal property is movable property, like vehicles, equipment, and other stuff. And you have it here: buildings, equipment, furniture. They say that you can elect to use a de minimis safe harbor to deduct the cost of some tangible property. Under the rule, you can deduct the minimis amount paid to acquire or produce certain tangible business property if these amounts are deductible by you in your financial accounting purposes or in keeping your books and records. See the following for the requirements. You have an applicable financial statements. If you elect the de minimis safe harbor for the tax year, you can deduct amount paid to acquire or produce certain tangible business property. Trader business. Okay. You treat the amount paid during the tax year for which you make the election as an expense on your account of applicable financial statements in accordance with your written accounting procedures. So you have a written accounting procedure and you paid for the property. Your payment doesn't exceed $5,000 per invoice. If you do not have an applicable financial statement, you still have to treat the property as an expense, but you have $2,500 as a rule. So let's go back to our examples, and we add another transaction here. I will just copy everything. And we say that we acquired an equipment for $2,000 here. And we say that under our accounting policy, we treat assets, let's say equipment. Let's be more precise here. Under our accounting policy, we treat equipment of less than 2K value. We treat such equipment as expense. And in that circumstance, let's call it, okay. That's not mortgage. Let's call it, let's just leave that header. Okay, so since we have that policy, it also applies to our accrual basis of accounting. And such policy, it's a bit complicated matter, because if you are a very small business, $2,000 can be significant for you, and it will depend on your treatment of everything. But in that case, so you just recognize outflow cash, 2,000, and you recognize it as an expense in your books. And same happens in the cash basis accounting. And the tax treatment. So tax treatment for that, will also be expense under both circumstances. Why is that? That's because there is let's copy the description here. De minimis safe harbor to tangible property. De minimis, see publication 538. Okay. Have you got any questions? Just give me a call if you got any questions. Send me a message. I have 538. Okay. That's where accountants can really add value for the business. In some circumstances, like here, if we record a small value assets of $2,000 assets, if we capitalize it for tax as well. In our circumstances, we kind of we got the legal grounds to expense it in the tax accounting. For example, if you run a rental, if you are a landlord, and you buy all the appliances for your rental, like a kitchen oven, microwave, dishwasher, fridge, all of these appliances can be expensed in the first year under that de minimis capitalization threshold, de minimis safe harbor for tangible property. I would assume your fridge is less than $2,500. So that's where accountants can bring some real value to the business. Or if you are a business owner, you might want to ask your accountant about that de minimis threshold. So you need to meet just a couple of criteria to be able to meet that threshold. So let's look at the 2,500. They have a condition here that you have an applicable financial statement. And I cannot really tell you right now how to meet that criteria. So basically here is the definition of applicable financial statement. Basically it says that you need to have a certified financial statement. That means that you kind of have a CPA who certifies your financial statement. And that is not the case for most of small businesses. That is why for small business your threshold is usually 2,500. So you have to have a business to take the deduction. You have to have an accounting procedure which would say that transactions up to such amount will be an expense and will not be capitalized. So you need to treat that as an expense on your books. And also you need to figure out what capitalization rules are in order to treat that as an expense. Okay, let's move on to further transactions. Let's go back to MIT We are 37 minutes into the lecture. Let's go back to MIT and see. Hopefully from that treatment you kind of get some grasp. So cash flow accounting is merely impacted by cash. If you got cash outflow, you recognize an expense. If you got cash inflow, you recognize some form of an income. Basically, cash outflow and cash inflow with loans and borrowings is either omitted, so it's not, when you get a loan, it's not an income, but that will be like a financing activity for your business. And accrual deals with revenues and expenses when revenues are earned and expenses are incurred. So they add here that it's also a credit transactions, barter exchange, change in price, changes in form of assets or liabilities, and other transactions. Accrual accounting does not require a concurrent cash movement in order to record the transaction. So basically, you record revenue when it happens. For example, if you sell a product, it's when you transfer title to your customer. Cash flow versus accrual accounting. Over the entire life of a corporation's total income under cash flow and accrual accounting is the same. So if you take a look at the corporation entire life from the beginning, from the startup stage till the liquidation, at the end the bases will correspond. Because even if you earned some revenue, for example, if you earned a revenue but haven't received cash, you will have a difference between cash accounting. So in cash accounting, you will not recognize that revenue. In accrual accounting, you will recognize that revenue. But if you haven't received cash ever, you will have to recognize a provision for that receivable and eventually write off that receivable. So basically, in cash accounting, there will be 0 transactions for that situation, and 0 net result will be 0 for that situation. In accrual accounting, you will recognize revenue and receivable, and if you haven't received cash, you will have to write off, you will recognize provision expense, and you will credit the provision for accounts receivable, and eventually you will write that off, and you will have 0 at the end. So basically, yes, that at the end of the life, it will be the same, the result will be the same. However, cash and accrual basis will reflect differently in different periods, because if you remember operating cycle, your cash outflow happens at the beginning of the operating cycle, then you recognize the expense, earn revenue, receive payment, and at the end you got cash at the end of the operating cycle. So your accrual cycle will be kind of a shorter or the same as your cash cycle. Similarly, many of the cash outlays may relate to activities and efforts to be undertaken in future periods. The matching principle in accrual accounting addresses this limitation of cash flow accounting. So the matching principle is that your expenses must match your revenues. So when you recognize a revenue, you need to remember that you could have incurred some expenses to earn that revenue. For example, if you sell some inventories, you recognize revenue from inventory sales. You also need to recognize the expense for the inventories which you used in such sale. Cash flow versus accrual accounting. Stock price. So they give you a few examples here, like if you want to calculate the value of the stock price via the valuation, via discounting cash flows, you will look at future cash flows. And everything in stock valuation is about cash flows. It's not about accruals. But if you look at how stock market reacts on the earnings numbers are usually based on accrual basis, and that's why it's a good field for discussion here, that which one is more important, cash flow or accrual basis. And a couple of arguments they made here that future cash flows are important, forecasted, because they are used to value in the company. And accrual basis and accounting, it's backward looking. So it looks at the past, future cash flows looks at the future, and your current earnings are more associated with your future cash flows. So if you expect that your future cash flows will deteriorate significantly in the future, your current earnings might be already reflected that in the form of goodwill impairment, intangible assets impairment, PP&D impairment, accounts receivable impairment. If you expect bad cash inflows, it will already be reflected in your earnings. Accounting earnings and the stock price. Everyone in the management is incentivized on their earnings. So why are bonuses not linked only to the stock prices? That's because the stock prices can be impacted by various factors not related directly to the management performance, and that's why management compensation is based on accounting too. Accounting earnings and stock prices. So there is more relation between management actions and accounting earnings. So when management take actions like cut expenses or introduces new products and generate more revenues and more profits, it's directly reflected in the financial statements, in the earnings, but it might not be reflected in the stock price, or something else might impact that stock price. Okay. Based on the earnings, accounting earnings, and the stock price, a firm can reward a manager appropriately. Okay, so what else do we have here? We have a discussion about accrual accounting and periodic adjustments. So we say that accountants record exchange transactions, and that's true. We got, when transactions happen, something is exchanged. You either exchanged cash for something, for example, cash for inventory or cash for building, or you might exchange your raw materials for finished goods when you do a production process. Or you might exchange, what else? You might get cash and record equity. That's also kind of an exchange with an owner of the business. But these types of transactions, they happen when you have some kind of an agreement in place, written or oral, with a customer or with a vendor. But there is some group of transactions which will not require a written agreement. For example, we need to record some transactions that have taken place, some activities that have taken place, but which we haven't recorded already. And the best example for such transactions is depreciation of your property. like if you bought a building for $100,000 and you expect that building will live 10 years, that its useful life will be 10 years, you need to depreciate that building over 10 years. And for that reason, every month you depreciate that building without any like a cash exchange. You just do it periodically. Let's see what we have here. Yeah, if we remember Blockbuster example where they capitalized, so they both bought a movie for $20 initially, and then they expect that they rent it out 50 times in the first year and 17 times in the second year. So they need to recognize 15 of expenses in the first year and 5 in expenses in the second year. And with that being said, that is a periodic adjustment. So in first year we record 15, in second year we record 5. Accrual accounting and periodic adjustments. In many cases, assets and liabilities are created or discharged without the occurrence of a visible, documentable exchange transaction. Interest is earned continually on a bank savings account as time passes. Machinery depreciates as it is used in a company operations. So except for just recording invoices from vendors or cash receipts from customers or other types of transactions or getting mortgage or acquiring fixed assets, accountants must also remember that they have transactions which are happening by default without any like events. So they have an activity like an income generating activity, like for example if you earn interest, or expense generating activity. And you must remember and you must have a list of such items, and you must record items like that every month. And this is called adjusting journal entries. So here is a list of characteristics of such entries. So they are to match expenses and revenues. They must involve one temporary revenue, expense, or dividend account and at least one permanent assets or liability. And they never involve cash account, because when you got a cash movement, it is 100% a transactional situation. So you must, for every cash movement, you must have some supporting document, and that is a transactional situation. So for example, with an interest expense or interest income, you earn interest income, but you might be receiving cash only once in a year. And in that, or if it's at some kind of discounted bond, you might get your cash at the end of the useful life of the bond, which can be many years out. And in that situation, that's better to that's a must to record these transactions on a periodic basis. Expense of revenue before cash. They provide you with some types of adjustments that you earn expense of revenue before cash, expense incurred today but cash paid tomorrow, revenue earned today but cash received tomorrow. That's an account receivable. That's an account payable situation. We already covered that. Cash before accruing revenue on the expense. That's prepaids for customers, from customers, and prepaids given to vendors. We already covered that situation. So we're done with that file, and the last statement to review will be income statement here. page 22 in the audit guide. If you haven't already done so, here is a link to the audit guide. So income statement. It involves input from many different accounting transactions. Accounting standards as well as SEC regulations. And from time to time that guidance updates, like for example in 2014 we had a major revenue update. And the format of income statement might be one step or two step. In one step, you just group together income and expenses and calculate net income. In two-step format, you got like a subtotals like gross profit margin, operating income, and that's to facilitate decisions taken by the users of the financial statements. And here is an example, and you might find out that these headers are almost the same as we looked into with Apple or with AMC or with any other company out there. That's because most of the bold ones are the requirements, and you see the depreciation expense is not bold, but they say that entities may choose to present depreciation expense separately in the income statement. Impairment loss. So basically, even though these are not bold, you need to consider additional guidance if you want to reflect that as in your financials. So we start with net sales and cost of sales, calculate gross profit. Then we have other operating, selling and general, doubtful accounts, depreciation, impairment, restructuring, other general expenses. We should have operating profit somewhere here. So at the end we have income from continuing operations here, income loss from continuing operation before income tax. Yeah, we might want to have some operating subtotal here for the management purposes, and we also have discontinued operation. Next homework will involve preparation of income statement. And if you want to take some header from here and come up with transaction for that header, you can do so. So we are running out of time for that lecture. I am calling in. I'm inviting you to join this lecture, the next lecture, which we will do some. Where we will do some exercises with accounting publications, which we have just reviewed. Let me send you the link here. Accrual and cash basis of accounting. Oops, not working that way. Let's meet on the next stream. It will happen in 10 minutes. We are a bit late to the schedule, so I'm ending this stream.